funds invest only in large cap stocks, mid cap stocks, or small cap stocks? A video on understanding the different categorization of stocks according to market capitalization. Given the recent flight of funds from many of these stocks, especially in mid cap and small cap stocks in the Indian stock markets, I'm your learning partner Sushila Hariharan. If you are interested in a career in investment banking, global markets, and hedge funds, subscribe to my YouTube channel where we provide content centric videos on these topics. Recently, there has been a lot of noise about what are small cap stocks and mid cap stocks and why are these stocks being hammered on the stock markets. So let's understand what is the meaning of this term cap. Okay, first things, market capitalization is a term that is used to define the size of a company or the value of a company on the basis of two very important parameters. The first one is the share capital of the company, and the second is the share price. These two attributes define what is called as the market capitalization. So share capital, as in the number of shares multiplied by the market price of the stock, gives us what is called as a market capitalization. So every company is defined in terms of size in different contexts. For example, we can say the largest company in the world is a company which has like $10 billion in revenues, or the smallest company in this market is a company that has less than 2 million in revenues, or the second largest company is one that has got $1 billion profits. Okay, but in this case of market capitalization, we are defining two parameters: one internal to the company, that is the share capital, and the second one is external to the company, that is the market price, because market price is a function of what, not just the profits and the revenues, etc., but it's also a factor of what the investors perceive to be the right price for the stock. So therefore, market capitalization is a very important metric in order to determine the size of the company, not just by revenues, not just by profits, not just the number of factories or number of employees or number of customers, or how many soap bars they have sold, etc., but in terms of sheer interpretation of market's understanding of the company's growth potential. Therefore, on the basis of this, all companies in the in the country or in the markets are divided into three distinct categories. We will start off with the largest, that is the large cap companies. Large cap companies are those companies that have a market capitalization of more than 20,000 crore rupees as defined in the Indian context. In Further to this, we will say that large cap companies are the top 100 companies. Now, what are the, as per market capitalization, so what are the attributes of these large cap companies? The biggest attribute of the large cap companies is they've been in business for long. They have seen multiple economic cycles of ups and downs. They have stability in earnings, they have stability in revenues, they are growing at a steady pace. Large cap companies are generally considered to be a barometer of how steady, stable, and consistent returns can be. Large caps are normally included in the primary indices of that market that they are working in. For example, in the US, you have the Nasdaq 100, or in Tokyo you have the Nikkei 225, or in India you have the Nifty 50, right? These are large cap companies. That means the top companies as per the market capitalization. Extending it to a revenue or extending it to a rupee number, it works out to around something more than 20,000 crores. These companies generally have a stable capital structure. What do I mean by stable capital structure? By stable capital structure, it implies that they are not continuously in the business of raising capital. They have plans that have been made. They have done an IPO a few years ago. They are raising bonds, debt instruments, working capital requirements, etc., from the money markets or from the banks. And they have a very steady state kind of a capital structure as well. So they don't tend to be over leveraged, means they don't borrow in excess capacity as compared to what is their future projections. Many a time these companies have a significantly high proportion of retained earnings, and therefore any further growth for the company is generally characterized by internal accruals that are used for purposes of acquiring other companies or growing in setting up new plants, setting up new capex, etc., etc. All that takes place in the large cap companies. Now, just below the large cap companies is this mid cap company. Mid cap companies are those that typically have market capitalization of anything more than 5,000 crores right up to 20,000 crores. In number terms, they're typically the companies that are 101 to 250 in terms of market capitalization. Okay. Now, mid cap companies are as the name suggests, they are right in the middle. The promising ones who are using a smart set of capital structures, consistently growing their revenues, etc., have the potential to become large cap companies. But if they're not being smart about their financial capital or their capex plans have gone haywire and the business has acquired another company and that company's acquisition has resulted into a lot of losses for the acquirer company, they have a potential to even grow into a small cap company. Now, mid cap companies are liked by mid cap funds. Okay, mid cap companies are those that have a higher growth rate, but the growth rate in terms of revenues and profits is not as consistent as the large cap companies. Therefore, the stock prices reflects this volatility. Okay, and therefore the stock prices also are quite volatile in terms of growing quarter on quarter. Results don't necessarily result into a very high amount of money that is being allocated to new businesses. They have steady cash flows but not consistently quarter on quarter, etc. So these are the peaks and troughs that they witness in their business, because frankly speaking, it's got nothing to do with how they manage their business, but they might just be early on in the company's growth, right? So therefore, mid-cap companies are those that could turn into stars or could just turn into dust. Okay, so it's a sweet spot, and the financials of some of them are extremely good in one quarter, but they are not so good in the next quarter. So they are exposed to a consistent quarterly chase in terms of performance, in terms of revenues, etc. Then come the small cap companies. The small cap companies are having market capitalization of less than 5,000 crores, and they're the rest of the stocks. Okay, now small cap companies are those that are literally like should we say, we are taking a significant exposure by investing in them because they have a potential to do a phenomenal growth. Okay, so unlike mid cap and large cap, which have fairly stable revenues, that's the top line, small cap companies also have inconsistent or unsteady quarter on quarter revenue growth. And this is a big challenge for small cap companies, because when you're in the business of growth, you will want to have consistency in terms of revenues. Small cap companies unfortunately don't have that, but they are many of them which could grow, which shows phenomenal growth. Okay, like they can grow sometimes at more than 25-30% quarter on quarter just in terms of revenues. So there are many bright sparks in the small cap sector, but in the small cap stocks there's a big problem in terms of leverage, that is the usage of borrowed capital. Now, leverage is a double-edged sword. Okay, if you are able to do very good in leverage, if you're able to borrow at good, consistent, competitive rates of interest, then the cost of borrowing remains low and the company is able to then generate a higher return for the equity shareholders. But how small cap stocks use that leverage to be able to grow more than a large cap company is really it requires astuteness, requires negotiation skills, requires extreme smartness from the company's CFO and treasurer. And therefore, they do have the potential. But in this, they also are the ones that, because of inconsistency, because of unsteadiness, they can either grow like 25-30% quarter on quarter and then suddenly have a period of no growth at all. So small cap companies have this kind of behavior. what do hedge funds prefer? Hedge funds prefer a combination of all of them. Do I say that they don't like large cap because they're very consistent and very steady? No, they do, because the performance of many of the funds are benchmarked against the S&P 500 or the Nifty 50, etc. Do they not like mid cap stocks? Yes, they do, because when the company's growth just goes upwards into a different trajectory altogether, then the investors also stand to benefit. Do they hate small caps, or do they love small caps? Because hedge funds also are known to take high risk investment decisions. They do love small cap. They too have significant positions in small cap stocks, but they also do it keeping in mind that they have investors back home to answer to. So there is a combination of all of them. They like to trade in, they like to invest in, because they see a potential for extremely high returns where there is one. So small cap, mid cap, and large cap are thus categorized only to help investors decide what is the outperformance against the benchmarks and what are the parameters that investors have to look at for investing in these stocks. Thank you so much.